Welcome to The Explainer. Today, we're unpacking a massive, truly unprecedented spending spree that is completely reshaping the financial health of the world's biggest tech companies. We hear about AI all the time, right? The new models, the enterprise agents, the sweeping software integrations, but the brutal financial mechanics happening behind the scenes to make all that actually happen, that is the real story. And honestly, it's rewriting the rules of modern corporate finance.
$534 billion. I mean, just let that number sink in. It's massive. But you have to understand, this isn't just your standard yearly corporate budget. This is a high-stakes bet-the-company gamble. Big tech is placing a $500 billion wager on the future, and they're stretching their balance sheets in ways we literally haven't seen since the early dot-com boom. They aren't just dipping their toes in the water here. They are betting the whole house on an unproven future.
Okay, let's dive into this. Here's our roadmap for how we're going to trace this pile of cash. We'll start with the $534 billion AI gamble, decode free cash flow, look at the massive hardware drain, the shift to debt, and finally, those high-stakes risks.
Section 1. The $534 billion AI gamble. So to understand this immense strain on these tech giants, we have to establish what exactly they're trying to buy. The objectives are incredibly ambitious. They're racing to deploy advanced AI models globally, which means they absolutely must secure exceptionally scarce hardware, specifically those high-end GPUs. It's a total arms race for compute. At the same time, they're drastically expanding their cloud capacity, building hyperscale data centers that just devour gigawatts of power. To capture long-term dominance in automated software, they simply have no choice but to front-load all of this capital right now.
Section 2. Decoding free cash flow.
Now, what's really interesting here is how this changes our understanding of tech wealth. We usually think of free cash flow as the ultimate safety net. In plain English, it's just the surplus cash left over after paying regular operating expenses and equipment costs. For the last decade, this massive financial cushion is exactly what made big tech look completely invincible to economic shocks. They were basically cash-printing machines.
But on the flip side of that, we have CapEx, or capital expenditures. This is the opposing force. It's the money spent to buy and upgrade physical assets, the concrete, the steel, the advanced servers for these AI data centers. And this eats directly into that leftover free cash flow. The sheer velocity of this spending is wild. We're not talking about minor server upgrades here. They're tearing down old infrastructure and building entirely new liquid-cooled supercomputing clusters.
And this brilliantly illustrates the historic pivot we're seeing. For years, big tech used its massive free cash flow for traditional investments, returning wealth to shareholders through highly predictable stock buybacks and dividends. Wall Street loved that comfortable rhythm. But now, they're aggressively funneling that exact same cash directly into massive physical infrastructure. They are pausing the mechanisms that inflated their stock prices for years, literally trading short-term shareholder returns for long-term survival in the AI era.
Section 3. The massive hardware drain.
Let's physically follow the money. It's like a domino effect. First, they generate massive cash from their core, highly profitable businesses, like search and cloud. But instead of hoarding it, they immediately divert those funds into specialized processors and new data center real estate. This spending is so intense that they are actually exhausting their internal funds. They're spending it faster than they can print it, which eventually forces them to cross a line they haven't crossed in years, turning to credit markets.
So who is actually catching all that drained cash? The capital windfall winners are semiconductor manufacturers, specialized hardware suppliers, and, perhaps surprisingly, energy providers. The chip designers are seeing massive revenue spikes, while utility companies and grid operators are securing huge contracts just to power and cool these hyperscale facilities. This is where that $500 billion is actually landing. It's a massive wealth transfer from software giants to hardware and energy.
But here is the real kicker. AI chips become outdated incredibly fast, requiring constant reinvestment. It's kind of like buying a massive fleet of wildly expensive luxury cars that become obsolete the second you drive them off the lot. A $50,000 GPU today might be totally outclassed in just 3 years by the next architecture. So they can't just build this infrastructure once, they are locking themselves into an incredibly expensive, never-ending hardware treadmill.
Section 4. The shift to debt.
This is the wait what moment of The Explainer. We are looking at historically cash-rich companies suddenly needing loans. They've gone from a totally self-funding business model to relying heavily on external credit markets. To keep up with the relentless hardware demands of training these models, these behemoths are actually issuing corporate bonds. They're tapping into debt markets, behaving way more like capital-intensive airlines or telecom companies than the nimble software innovators we're used to.
Let's see how this builds, because every single action triggers a severe financial consequence. Increasing AI spending directly drains their liquid cash reserves. Reducing those traditional investments to free up capital means there is far less money available for stock buybacks. And finally, turning to credit markets inevitably inflates their corporate debt levels. They're adding massive interest obligations to balance sheets that previously only held cash.
So why does all this matter for us? Because these, once bulletproof giants, now have far fewer financial reserves to cushion against unexpected economic downturns. As a direct result, they're facing heightened scrutiny from investors and credit rating agencies who are watching their every move. If a recession hits or their core revenues dip, they no longer have that endless, bottomless war chest to fall back on. Their risk profile has fundamentally changed.
Section 5. The high-stakes risks.
We've seen the massive spending, but this entire strategy relies on one massive, precarious assumption: explosive customer demand. If consumers and businesses don't adopt these tools as fast as Silicon Valley expects, big tech will have wildly overspent. Add in the reality of holding depreciating hardware plus higher interest obligations from all that borrowing, and you get severely compressed profit margins. If the massive ongoing costs of running these services exceed the revenue they bring in, the math simply breaks down. They have to monetize generative AI at scale, and fast.
So, what does this all mean? Will AI demand ultimately cover these massive costs, or is big tech building a $534 billion house of cards? It's arguably the most expensive financial gamble in modern corporate history. Whether this immense infrastructure ushers in a new era of productivity or collapses their profit margins under the weight of debt is a question that will absolutely define the global economy for the next decade. Keep your eyes on the numbers.